year defined by tariffs, geopolitical tensions, and a softening dollar, commodities have stopped being a sideshow and become the story. Gold is at new record highs, energy is volatile, as it often is, and metals are carrying the weight of AI, the energy transition, and rapidly rising defense spending. What are the risks and where are the opportunities? Nitesh Shah has shared his views in WisdomTree's latest outlook on commodities, and I will ask him about it in this episode. Welcome to the Commodity Exchange, a podcast where we bring you insights from the world of commodities, whether you are an investor or just want to learn more about the topic. This podcast is for you. I'm Mobeen Tahir, Director of Macroeconomics and Thematic Research here at WisdomTree.
And I'm Nitesh Shah, the head of commodities and macro research here at WisdomTree.
So, Nitesh, we have just published our latest set of outlooks at WisdomTree, and as the author of the Commodity Outlook, I know last time when you wrote the outlook back in March 2025, you titled it Finding Antivenoms in the Year of the Snake. And this time you've titled it Tariffs, Tensions, and Tailwinds in a Realigning World. First of all, love the alliteration. And secondly, just give us the background as to what has happened in the world of commodities since you last wrote the outlook and you called it the year of the snake and finding antivenoms. Have we been able to find the antivenoms? How did things pan out? And what sort of a context do you find yourself in as you have written this latest outlook and called it Tariffs, Tensions, and Tailwinds in a Realigning World?
Yeah, thanks for that great intro and question there. So, back in March when we published that version of the Outlooks Finding Antivenoms in the Year of the Snake, we thought about the Year of the Snake as that potentially tricky, slippery, difficult year that lies ahead of us because we have significant disruption to the status quo at that point. The new administration in the US, we know, was looking towards putting in tariffs, which could drive a trade war. And was very ready to dismantle a lot of the climate related policies that were underpinning some commodities. But back in March, we had absolutely no idea of how deep the shock would be on the tariff front. Liberation Day came in April, and the tariffs announced at that point were a lot worse than even what we had expected, and we were looking down the barrel of some significant shocks there. Obviously, we had that world in which the world was, given that shock, but then the tariffs were somewhat negotiated down, and so people felt the markets almost felt some degree of relief by sort of June, July time. But it's relative relief because the tariffs have ended up being a lot larger than we started off the year in, and probably a lot worse than we were even imagining back in March. So commodities, if we look at them as a group, have dealt with this period relatively well, and that is in part due to the diversified nature of commodities as a group. You have at one extreme, you have energy commodities, you have industrial metals, which are highly cyclical, highly in tune with the macroeconomic conditions in a kind of a positive cyclical way. So when you do see disruptions to growth that may come from trade, they would be hurt. But on the other side, you have commodities like gold, which are highly defensive. And as a result of that highly defensive commodity gold, we've actually seen the commodities as a group do very well. Gold is up close to 38% year to date, 40% year to date for silver, 50 plus percent for platinum year to date. Because of the performance of these precious metals, the group has done really well. Um, then that's helped paper through the negative performance in energy markets. Um, Now, industrial metals have been somewhere in the middle. They haven't fallen, but they don't look particularly impressive when you compare them to say other cyclical assets like equities. And that I would characterize industrial metals to have gone through a lot of volatility. Some industrial metals had accelerated, uh, especially their prices in the US bourses, because they were expected to have been tariffed, and the prices on the US bourses were to reflect the post tariff level of that commodity. So their prices are artificially gone up, but then came crashing down when the tariffs hadn't quite captured the final refined version of those materials. And copper is a clear example there. Everyone expected refined copper to become tariffed, and when there was an exemption for refined copper, its prices fell. So there's been a lot of volatility in many of these commodities. So it does align with our original thesis of the year of the snake being a very volatile, difficult year. But on the whole, if you're looking at it from an investor standpoint, um, holding commodities as a group has been a great place to be because we've seen some particularly strong performance this year. And that speaks volumes about the power of diversification and using commodities as a hedge for some of these macro shocks.
A lot to unpack there, and we will certainly go through each of those topics in turn. But I know as you set the scene, Nitesh, in your outlook, you talk about dollar depreciation being very relevant for commodities. Of course, you outline the historic relationship between the dollar and commodity prices, and you also offer different mechanisms in which dollar depreciation can affect commodities. Tell us about these mechanisms and the significance of dollar depreciation for commodities, particularly this year.
Yeah, absolutely. So dollar depreciation, when you look at commodities price in dollar terms, almost mechanically, when dollar softens, and even if you don't get the change in value of that commodity in other currencies, it will, in dollar terms, it will fall. Right? That's a pure mechanical process. But beyond that, there are other forces that really help commodity prices when dollar depreciates. Now. When the dollar is cheaper, um, the affordability of those commodities for other countries, say if you think about emerging market nations in particular, the fall in dollar price will mean that the other countries can afford those commodities higher, boosting its demand. Um, a When you have a dollar depreciation, the inflation hedge appeal of commodities, it tends to increase, and you see a lot more demand for real world assets. So things like real estate and commodities can do particularly well. Once again, providing that dollar boost. Also, you get the producer margins may also be supported when you got dollar depreciation. So when dollar depreciates and you're a country exporting into and selling your product in dollar prices, because they may receive uh, uh, that little bit more in dollar terms, they may choose to suppress their supply of that commodity, and therefore, actually, that holding back of supply may also act as another boost for that commodity. So there are multiple mechanisms for in which commodity prices get supported when you have dollar depreciation, and that dollar depreciation has been strong this year. Yes, we came from a relatively strong dollar towards the tail end of last year, but with more than 10% depreciation, it's been a very meaningful impact for commodity prices.
Nitesh, of course, you mentioned the idea of tariffs, and as we set the scene, of course, tariffs arguably have been one of the biggest market movers in general across asset classes in the first half of the year, particularly. Now, with regards to commodities, it's not always clear what the impact might be. Will tariffs affect the demand side of the equation? Will they affect the supply side of the equation? We had a clear example, though, as you mentioned, with copper, as to what can happen to prices in both directions as developments become clearer and we know more about what's going to happen with regards to tariffs. Now, outline what happened with copper and maybe just set the scene as to whether you believe tariffs are still an important driver for commodity market volatility going forward. How do you see the tariff issue affecting the asset class?
Yeah. So maybe looking to your first question first. So the devil's always in the detail, right? When it comes to tariffs, and there's a lot of detail to get through. Um, if you think from a classical standpoint, if the price of a certain good goes up, and that may be artificially going up because of a tariff, you'd expect, other things being equal, the demand to be depressed, and that eventually to have a dampening effect on the demand and therefore the price. But in these scenarios, we're looking at very, um, you know, idiosyncratic issues here. So when we think about prices of copper, there are multiple prices of copper. We've got a futures contract which is traded in New York on the COMEX exchange, and the price of what's traded on that exchange is effectively the after tax and after tariff price of that commodity. So if tariffs are implemented on the final product, which is the refined copper, which is deliverable to those warehouses, then the price of that contract should theoretically go up by the level of the tariff if tariffs are implemented on final refined copper. Now we went in to into July expecting that tariffs will be applied on copper because of social media posts by Trump earlier on in the year, saying something to that effect. He didn't say specifically on refined, but he said copper in general. And the blueprint was already there because there's already a 50% tariff on aluminium and steel. And so it felt logical that the final refined metal in copper would also be tariffed. But it turned out that refined copper wasn't going to be tariffed on day one. The door's still open for it to be tariffed later on, possibly in 2027, subject to a study that will come out in 2026. Um, but that led to a lot of price volatility. So prices ramped up heavily for COMEX copper, and COMEX copper was a lot higher than other copper prices around the world. For example, the LME copper price, based London Metal Exchange price for copper, or the Shanghai Futures Exchange price in China. So there's a big price differential that was opened up, and then that got closed out again. So you're seeing a lot of this kind of volatility. Now, so we can talk about the micro story of an individual commodity, but it has broader ramifications because these points of uncertainty become something that unnerves a lot of investors, and that anxiousness and unnerving leads them to become somewhat risk averse and maybe go towards assets that they reach out for in times of anxiety. And one of the prime examples there is gold. Right, gold is that go-to asset when people are uncertain about the world and the state of the uh, level of change and the uncertainty of where the policy dynamics will head. And so gold has been possibly one of the clearest beneficiaries of tariff uncertainty overall, but gold as an asset has also had its own micro uncertainty because um, there has always been um, ambiguity about whether gold bullion would be tariffed. In April, during Liberation Day, there was a clear exemption for gold, but then come uh, August, that was put into question when the Customs and Border Agency said that they wanted to tariff gold from Switzerland, at least the kilo bars and the 100 ounce bars that are coming in from Switzerland. So that caused some complications. Now, this past weekend, and we're recording here on the 8th of September, sorry, actually on Friday, the past Friday, and we're recording on Monday the 8th, there was a clarification given that bullion will be fully exempted. So that's calmed the markets once again. But these levels of uncertainty persist in the markets and they can lend support to defensive assets like gold.
It was certainly incredible to see the price action in copper COMEX. Not something you expect to see in a base metal. Almost something you expect to see maybe in other asset classes, a lot more speculative in nature. But certainly, it shows, as you said, the impact of tariffs and the volatility that can create, even in base metals and beyond. Now, you mentioned gold. Let's explore that topic a bit further. Of course, there is the support coming from tariff related uncertainty, but there are certainly other factors at play as well, which you do talk about in your outlook. Now, of course, as we record this on the 8th of September, we are seeing gold at new record highs. And we've talked about your gold model on this podcast in the past, and you keep getting proven right with your bullish views on gold. Tell us how you see gold's price trajectory and what lies ahead.
Yeah, so you're right. Gold at record highs. This is, is quite an interesting moment to see, given how much gold range traded for several months after that big acceleration back in April, May. And it's clear that a lot of the things that we talked about in the outlook are really relevant to gold. So the dollar depreciation story, very, very relevant to gold. Yeah, gold gets a lot of its uh, price increase from dollar depreciation. And I maybe should have added earlier on that we think this dollar depreciation will continue. We looked at some long term structural factors that tend to drive dollar depreciation. One of them is the so called concept of a twin deficit, so a deficit in the current account. Combined with a deficit in or a budget deficit, that combination of government debts and the trade imbalances that tend to occur that drive that current account deficit. Um, they can be very supportive for dollar depreciation for some time. And the lag between those twin deficits emerging and that dollar depreciation happening is quite long. So it's close to a 3 year period. So we've been observing these deficits widen for a while, and really we're at that point where we're at that 3 year gap between the sort of inflection point, and we think that there could be a very explosive driver of dollar depreciation going forward. But it's not just that. We are about to enter a rate cutting cycle. Widely anticipated that the Federal Reserve will cut rates very soon. It's had weak labor market data to support such action. Obviously, a very sharp revision in labor market data last month, and in the past week we got the data for the month of August as well, indicating that very few jobs were added to the market. We are going into cyclically higher unemployment, which gives the Fed its excuses to cut rates, even though inflation may be still a bit on the um, the high end of the spectrum. And even though inflation doesn't look like it will get down to the Fed's target levels anytime soon, the weakness in the labor market, and bearing in mind the Fed has a tri mandate, with inflation, unemployment, and that's interest rate stability, um, to look after. It looks like it's focusing a little bit more on the latter two at the moment. So rate cuts going to be good for gold, but broader than that, if you think about central banks in general, I think there's a lot of support for gold. One is coming from the Trump administration attacks on the Federal Reserve. He's Trump's very vocal, displeasure with Powell has um, led to a lot of people thinking about how the Fed will be able to react to this current environment, and whether it will water down on any of the Fed's independence. Obviously, his attack on Governor Cook, and calling for her resignation or removal. I think that's all feeding into the narrative of, can the Fed remain as independent, or can it be seen to be the perception of the Fed, can that be as independent as it always has been in the past? And I think that makes people worry. And when you have a central bank, which is this effective owner of the currency, um, if the fiat currency of the dollar is put under any question, then the alternative to those fiat currencies, a hard asset like gold, becomes a lot more in favor. And I think gold will get a huge lift as a result of this turmoil in institutional credibility, I guess, if we can put it that way. So multiple drivers of gold prices going forward. Increasing indebtedness is another aspect, not just in the US but globally. But obviously, there's a lot of focus on the US, with unfunded, tax spending and budget cuts going on in the US as well.
There's an interesting dynamic, Nitesh. If an investor is sitting outside the US, say Europe or the UK, we know and we've talked about how dollar depreciation helps gold. But if you are holding gold as a US dollar denominated asset, then when you translate it back to your local currency, you miss out on the translation of your investment return. So anecdotally, I know at WisdomTree we've seen that investors, say in Europe or the UK, outside the US, they're looking to benefit from the dollar depreciation aspect as far as the asset class is concerned, but to protect their investment, they're turning towards hedging the currency risk. How do you see this dynamic? Is that a smart decision in this scenario, in this environment where maybe we might have more dollar depreciation?
Yeah. Hedging can protect the proportion of gold price increases that coming just from dollar depreciation, right? If you are a non-dollar based investor, so I think there's a almost a slam dunk case for hedging, especially if hedging was free, right? If hedging was free, then you'd protect that amount, and if you believe that the direction of the dollar for the medium term is to go lower. But obviously, hedging has some cost to it, right? You have to pay for that hedging um, uh, addition, whether you're hedging yourself or whether you're buying a product that has a currency hedge already embedded in it. You have to pay for it. Now, I think the cost benefit becomes overwhelmingly attractive in gold bull environments. The analysis that we've done, it has shown that when gold prices are rallying, when gold price bull environments, um, the benefit to hedging that gold price movement from currency overwhelmingly becomes attractive. You protect most of the upside in gold prices, and you pay a relatively small proportion of your overall gain on that hedge. and therefore it works out to be a good time to do that hedging. So for the foreseeable future, we are in a gold bull environment, and I do think that hedging does make a lot of sense today. And as you say, this can be done either embedded in the project in the product itself, or if you're a client that has the capabilities of doing hedging outside of that, that's also a viable option.
Very interesting. You also mentioned, Nitesh, at the beginning how we've seen strength across precious metals, beyond gold as well. Silver's been interesting. Platinum, very impressive returns year to date, strong performance. There's, of course, the correlation effect, which we've often talked about on this show between those various precious metals, but they all have their own dynamics as well. Uh, which PMs, precious metals, do you think warrant attention at this point in time?
Yeah, so I do think the three that you mentioned are very interesting, right? Obviously, we've talked about gold, but silver and platinum are particularly interesting because they have a correlation with gold. And let's focus on silver first. It's almost like a leverage play on gold. It has a relatively high beta to gold. Our models indicate around 1.4. So um, that means that when gold prices go up 1%, you'd expect, other things being equal, silver prices to go up by about 1.4%. Um, so so it moves in the same direction, but usually by a little bit more amount. I did say other things being equal in our model for silver. There are other things that matter for silver prices. Now they may not be going necessarily in the same direction, price support direction, but other things that are worth considering are where are supply and demand factors for silver moving. And the demand for silver is largely driven by industrial applications, which has been holding very steady and strong for silver specific uses, particularly including um, solar panels and electrification needs. So that's quite supportive in of its own. And supply has been relatively constrained. And when you think about silver, a lot of its supply comes as a byproduct of mining for other metals. So even though we've seen a nice rally in silver prices, 40+%, it doesn't mean that silver miners all of a sudden start putting a lot more silver out the ground, because most mining of silver is a byproduct of mining for copper, nickel, zinc, and other metals. So, unless the prices of those primary metals go up, you won't see the miners increase so much more of their supply. So supply is relatively well constrained. Demand is still very good, and it's got this nice correlation effect with gold. Now, if we look at relative pricing, and something I look at a lot is the gold silver ratio, um, that had hit a very high level a few months ago, before silver started making catch up with gold. It's come down a lot, but it isn't back to long term historical levels. So, if you look at long-term historical levels for that gold to silver ratio, they're closer to 70, and we are around 80 at the moment for the gold to silver ratio. So there's still further, I believe, silver can go. So I think silver's got a very nice backdrop to it. Platinum is has been we've done a number of podcasts on platinum, so I won't go labor the points too much. But it's clear that platinum was range trading for almost years, up until this year, and we've seen a massive blowout. And the strong fundamentals that were there for platinum had been there for a while. That there isn't a supply deficit. It's hard to increase that supply considerably that much more further. But I think the gold rally has almost ignited a lot more tension on the platinum narrative, and I think we may see the uh, the demand profile for platinum remained a little bit more healthier than what was assumed historically, because the internal combustion engine vehicles may be in vogue or in demand for a bit longer than what people had estimated several years ago in terms of that transition away from ICE internal combustion engine vehicles towards electric vehicles, at least in some markets like the US and potentially Europe. I still think that China is moving full steam ahead with this transition to EVs, but maybe it's slowing down a little bit in some of these other jurisdictions. So demand remains quite supportive for platinum too.
So let's turn our attention now, Nitesh, on another sector which probably hasn't seen as good a macro backdrop as precious metals, but important nonetheless. Energy, and of course, over the course of the year, we've talked about how geopolitics has been an important driver in adding a risk premium to prices. But it seems like lately it's all been about OPEC plus and how their output increases are driving the narrative, and the narrative generally is weighing on oil prices. uh, but there is still volatility for various reasons. What path do you foresee for oil prices going forward?
Yeah, I think that is probably the more bearish end of our outlooks. Is really focused on the oil sector, and we've been somewhat bearish on this for a while. OPEC had put in various restrictions on its production for a while, and if we could characterize it, its restrictions were almost in three layers. It has its initial group wide uh, cuts on production, which amount to about 2 million barrels per day, and that were in place since October 2022. And then they introduced another layer of restrictions, which are voluntary, so it doesn't apply to most of the group, but at least eight of the OPEC plus group um, were under these voluntary restrictions of 1.65 million barrels per day. And then you had these additional voluntary cuts, which came in November 2023 of 2.2 million barrels. Now, that last layer, that third layer, had been pretty much removed by this month. So in the tail end of last year, the OPEC group said it's going to start unwinding this third layer over the course of 2 years, and within um, the span of a year. So by it's basically September 2025, they've almost removed that third layer of restraint. But this past weekend, we found out that they're already chipping away at the second layer of restraint. So that 1.65 million barrels per day that was introduced back in April 2023 is already starting to get removed. So 134,000 barrels per day of production increase. But in October 2025 is put on the slate, which is actually chipping away at that second layer. We could see that almost being accelerated as well, like we saw with that third layer. I think OPEC is dead keen on restoring its market share. And for as long as the market keeps absorbing these new barrels that it's putting out in the market, and it has so far, it will continue to do so. So the surprise on my end really is the fact that oil prices haven't fallen that further, right? Oil prices have fallen, but the market is seemingly absorbing these. Yes, we are at 60, 65 dollars per barrel at the moment on oil. With so much oil having come in, I would have expected the oil price even to be somewhat more damaged by this. So I think OPEC will continue that process of putting barrels back into the market so long as the market absorbs it. But we could be very range bound. We could be in this $60 range for some time, and we possibly could test a bit lower than that if OPEC is keen to figure out with the boundary really, and possibly introduce a little bit more oil. Now, the headline probably sounds a little bit more worse than the actual reality, because although OPEC are saying we're unwinding these restraints, some of the players within OPEC hadn't stuck to their quotas in the past, and they've gone on a program to make up for the fact that they've broken their prior quotas. So the reality is they're not adding that much more new barrels to the market as much as the headline indicates, which obviously softens some of the price impact of this. But I don't think we're going to see a near term rally in prices unless we get shock events, and that could the shocks, as we've seen in the past, could be due to disruptions to producing activity, potentially through terrorist activity, for example, or we could get a doubling down of sanctions or other maneuvers to reduce uh, either Russian or Iranian production. So those sort of things could happen that could narrow out supply on a temporary basis. But right now, I think we're in the process of getting more barrels come to the market. I guess the question then becomes what happens when spare capacity in OPEC has been eroded. But I think that's more of a question for a year's time or so, when we find out that OPEC hasn't got as much buffer in the system as it used to do.
So bearish, range bound, and volatile, but potentially offering some tactical opportunities as we go along. That's oil and the energy sector. But let's come back to another sector where we probably have more constructive views. Once again, Nitesh, and close there. This is industrial metals. And I really like how you've offered a couple of new perspectives. We've, of course, spoken about industrial metals on this show frequently from the perspective of the energy transition and how that creates a new source of demand for the sector. But this time you talk about a couple of new topics. One is the rise in defense spending, and of course, a lot of the things that are related to defense spending, from jets and drones and submarines. These things need to be built, and they require metals. And then also the the data center economy and all that goes into that and its relationship with metals. So talk us about how you see these two new topics and the impact on base metals. Can it be quantified? Can it impact the view, and has it impacted your view, and to what extent?
Yeah, maybe we turn to sort of the data center side of things first. Now, we've talked at length on this podcast and elsewhere about energy transitions, right? And when we talk about transitions, we're talking about how do we go from a hydrocarbon based economy to something that's less hydrocarbon intense, because there is these goals to reduce greenhouse gas emissions. But if we step back and think about it, there's been no transition whatsoever, right? Have we haven't transitioned from one set of energy sources to another. We've just added another energy source to the existing energy complex, because the pace of demand growth for energy is that high, right? So we're more. I think we do, a better way of framing what we're seeing is energy addition rather than energy transition, right? We need more and more sources of energy in any shape and form we can get to meet the demand. And that demand is rising rapidly because of things like data centers and the artificial intelligence, technologies that are a lot more energy hungry and more storage hungry, therefore being more energy hungry as well. And that is one of the new dynamics of the modern economy. So you know, and that's very power focused to start off with. So you need electricity more than um, you know uh, combustible energy at point of use. So whereas you think of cars and trucks and things like that being sort of very fuel dependent, AI is a lot more electricity dependent. Now, electricity can be made from multiple forms. It can be made from coal or oil or natural gas, the hydrocarbon end of the spectrum, or it can be made of renewable sources of energy or nuclear energy. These are all other viable options, but all of those are on the table for satisfying this source of demand. Now, because there are ambitions to limit greenhouse gas emissions, um, we will likely see the demand be tilted more towards the renewable end of the spectrum. So, everything in the renewable end of the spectrum ends up being metal intensive. If you think about wind turbines, if you think about solar panels, if you think about hydro dams, they all are very metal intensive, types of technologies, and all the things that support that those technologies like batteries and storage, because these types of technologies are inherently volatile because they're very weather dependent. You need storage of that type of energy source as well, which is also a metal intensive storage. So there's a clear cut case for why AI and data storage will become very important for metal growth going forward. But as you said, there's this change that we've seen in this world of tariff tensions, and global realignment, which is very defense oriented, right? So the U.S. is apparent withdrawal from support for uh, uh, Europe's defense, and it's pulled back from NATO. Without other NATO nations picking up the more of the tab on defense spending, has driven the Europe to increase its budgets on defense significantly. Now, what that means is when it spends more money on defense, it will need infrastructure, it will need more ammunition. And all of these things, once again, are metal intensive. Now, maybe it's not as metal intensive as the AI story, but it's happening at the same time. And the if you think about price formation of any commodity, it's the marginal unit that matters, right? So when you're seeing demand already strong, and you're seeing a new source of demand added on top of that, and simultaneously, we're not seeing a huge amount of new capex go into mining activity or production activity. That sets itself up for tightness in the market and is likely to be a source of price increases going forward. So we're very bullish on industrial metals over the medium term. Maybe the very short term, this we'll see a bit of volatility because tariffs may end up being a little bit price demand destructive in certain markets. So that may dampen a bit of demand in the very short term, but the medium term is very, very supportive for the industrial metal complex.
Very interesting and nice to be able to bring those new topics in, and it just shows the interconnected nature of markets and how the same things can affect so many different asset classes. But viewers, listeners, on that note, just a reminder that Wisdom Tree's latest market outlook is available, and if you want to explore more of Nitesh's views on commodities, head to Wisdom Tree's website where you can read the full outlook along with other chapters on equities, thematics, and cryptocurrencies as well. But with that, we thank everyone for tuning in. We hope you've enjoyed this episode of the Commodity Exchange. And before we close, I do need to state the following. To clarify, the views and opinions expressed in this podcast are those of WisdomTree and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. if you want to hear more from us, please subscribe on whichever platform you're using. And of course, follow us on LinkedIn or X. Visit our website for more information. And of course, for more research materials and insights. And stay tuned. We'll be back with another interesting